Welcome to the Canadian Wealth Secrets podcast there, Frank. I am so excited to have you on the show. I had the opportunity to chat with you and have a really awesome high-level discussion about what I think people are going to definitely interpret as a Canadian wealth secret that you're going to be sharing here today. And it's creative, it's unique, it's compliant. And the beautiful part is, I think it applies to many that are in the business world. So those people who are incorporated business owners, they've got this, secret sauce sort of waiting for them. But before we dig into that, tell people, where are you coming to us from? And, what is your role? Like, what do you do? And what landed you in this place where you're now sharing secret sauce ideas with audiences like ours here on Canadian Wealth Secrets?
Sure. Well, so my formal education is I did electrical engineering and I did an MBA, and then I did 25 years fixed income trading at TD Bank. And when you're trading bonds, fixed income is bonds. When you trade bonds, you generally have a situation where you have a set of rules and limits you have to follow, both internally, but also with respect to what your customers can do. And then there's the rules of the market. And obviously, you know that bonds are not an investment that are going to double or triple or, have a 10x type experience. So you're really kind of working within a limited return space. And so when I left that, I've always known that by the way, I've known a lot of the transactions I was working on before were driven by tax as well, oftentimes. So I was curious about tax. And when I left that area, I decided to look more into tax because it reminds me of fixed income. There's only so much you can make money from if you're modifying your tax liabilities, right? If you're paying the marginal tax rate, the most you could make on a transaction is 53% if you live in Ontario, and that's if you don't pay anybody else to help you.
Right.
As soon as someone's involved, like obviously the fees have to be lower than your benefit, but the point is there's not there's not a massive like equity type upside. So it reminds me, tax planning reminds me of fixed income investing. And in both cases, when you trade government bonds, and is the same as doing arbitrage or modifying your liabilities with CRA, it's a government counterparty.
I love it. So Frank, that makes a ton of sense. So you came from, this trading background, and I love your description there of essentially it's all about knowing the rules. You've got a box that you need to play with, and you're essentially looking for any sort of arbitrage inside that box. And when you start talking about the government bonds and you start to say, well, the rules change slightly because the box changed slightly, and the impact and the influence that might have with taxes or no taxes are going to come in. And ultimately what ends up happening, and where I think we're going to be sending this conversation today, is that especially when we have businesses, especially for those who are incorporated business owners or incorporated investors, that ultimately you're looking to the rules and playing within the rules, but then how do these rules sort of intertwine, right? And how can we utilize these rules in such a way that it's going to have a net benefit for us instead of it being sort of a negative, right? And of course, we could go at it the simple.
But one of the ways I describe it is if you just accept the default vanilla, right? If you accept the default from CRA, then that's one way to go. But why not be a little more inquisitive, maybe a little more active, and find out where are the opportunities. If you arrange your affairs, it's almost like order of operations. If you arrange your order of affairs, certain order come with a different outcome. So would you prefer that outcome? Does that change to your current method? Are you okay with that? Because obviously getting solutions where people don't want to do the solution, that's not going to work either.
Right. Absolutely. That's 100% agree. And something that's really interesting when I'm chatting with incorporated business owners is that ultimately what I hear, and this isn't new to me, but what I hear most often is that oftentimes they're looking to say they're accountants for creative strategies, right? Like they're looking for the secret sauce, right? They want something more than just sort of the same old, that plain vanilla, as you're saying. And the reality is that that's not really a place that you're going to find those tools, those ideas. thinking creatively requires you to be thinking about very specific scenarios and really trying to think about how do we take what we know about that scenario and create a more positive outcome. And you can imagine, as an accountant, you're there not to give creative advice, but rather to ensure that how we book this thing is correct, right? So ultimately, a lot of
Correct.
that heavy work falls on your own shoulders, or it falls on finding other people in different spaces, maybe in a space similar to yours, that have done this work, that have done this deep thinking, and have find situations and scenarios that are going to actually give you a little bit of a better positive income. And obviously that outcome has to be significant enough for it to make sense, right? That the time, the effort, the capital that you might have to put
That's
into
right.
it is going to result in a worthwhile profit, a worthwhile benefit. So that, I think, sort of helps to set the stage a little bit here. And I'm really excited to dig into this idea that you have, because I found it really interesting. You had reached out to me after sort of seeing, some of the things we were sharing, and that we're looking for these sort of unknown compliant strategies that we could be utilizing in different scenarios. And I hopped on a
Right.
call, and you definitely blew my mind with a really awesome structure. So I'm wondering, can you paint us a high level picture? What is it that you're going to be sharing with us, the Canadian Wealth Secrets community? And, who does this apply to? And then we'll try to get into some of the nuts and bolts. And of course, it's an audio program. We will have this up on YouTube, and we'll be sharing the screen for those who want to dig a little deeper. But ultimately here, I think what we're going to hope that people get is that, first of all, people that this could be helpful for are going to go, that's me, right? And then secondly, they're going to get a general sense as to what it is and what the benefit is. They may not have a 100% clear path on how they're going to do it, but we're going to get them to identify themselves as, this could be helpful for me, and it's worth exploring some more. And of course, we'll be sharing your contact details on the show notes page. So give us a high level summary. What is it that Frank McGillicuddy is going to be sharing with us here today?
So I think one of the things to think about what this does is it helps. There's another method. It's a new method, or a method that's actually, one of the things I say to people who run businesses is, some of your competition is doing this already. I don't know who they are because it's all private transactions. But if you think everybody is that nobody is doing this, I think that answer is incorrect. There are people doing this already.
Well, and if you think about it, right, a true secret, some people know about it. Otherwise,
Exactly.
you've created something. And we're not saying this is something that's been completely created. You didn't wake up in the middle of the night and say,
No.
this is my idea, this is my thought process, but rather that you've connected the dots, and in your exploration, you're seeing that actually some of the more in tune business owners and businesses have been creative enough to actually apply this. And what I'm hearing you say is that if some of your competition might be doing some of these things, they actually have a leg up because their costs are lower and your costs could be greater. Yes. And that obviously gives them a much, an unfair advantage.
So there's two ways you can look at this method. And one of the ways to look at this is a way to take money out of a Canadian private corporation that you own, and it's not a dividend and it's not salary. And I think it's more tax effective given all the various elements around it. The other way to think of it is you're reducing the capital cost of equipment that your company uses. And actually, I think it does both those things, but you might prefer one point of view versus the other. And so what you're really doing is arranging a situation where you don't own equipment inside your company anymore. You set up a partnership that leases the equipment to your company. So now you've set up effectively a leasing, but you're not a leasing company. Notice I'm not setting up a leasing company. It's a partnership. So now your company is going to pay the lease payments on the lease, is going to get to use the equipment that it has to use. And the partnership allows the lease income and the deductions for depreciation, which is also known as CCA, to go onto the personal income tax filing of the limited partner. Now, you can't do this personally. If you like, and I mean is that you can't do it without the partnership. If you decided to buy an excavator and lease it to your company because you use excavators, CRA is going to deny you
Right.
the depreciation on the personal income taxes because they're going to go, you're a related party. You
Right.
can't do this.
Non-arm's length is
Right.
we
Exactly.
need arm's length here, and we need to make this, where some
Yes.
other partner is involved. I love it. I love it. Keep going.
So the partnership to that point has a general partner who has to be at arm's length to the investor and also at arm's length to the company that is going to pay the lease. And so that's the critical component for the partnership. So really what this does is it lets the company get a deduction on its lease payment the same way it would if it did a deduction for paying you salary. But instead of salary, you're receiving cash flow, which is matched. Usually it's going to be matched by the depreciation expense. So it's effectively creating tax-free income as long as the depreciation is, above zero. And then we have a way of well, then what happens after that? Like, what do you want to do? And there are a couple different steps you could take to move the equipment into the corporation without triggering repayment of all the depreciation expenses you've taken on your personal tax return.
Right. Right. We don't
no
want that recapture.
Yeah,
or anything,
you don't want
right?
recapture. Like, what's the point if you can't get if there was no way around the recapture, I wouldn't be having this conversation.
Right. Right. Exactly. Exactly.
Because
You'd just be kicking the can a little further down the road, and that's not really a lot of work. So what I'm hearing in this basic idea, and from my understanding, when we had our conversation, there's many different scenarios and there's many different, possibilities and approaches. But if we use this excavator idea for a second, I've got a company, and we'll call that, the company is, a party, right? And they need to purchase, or they need the use of this equipment, but they don't necessarily need to purchase this equipment, right? And what I'm hearing you say is that they could actually, instead, a partnership could be formed, which is not connected to the company. A partnership would purchase this equipment and would agree to lease that equipment for a fair, value, right? A fair value to the company in order for this to take place. Now, tell me more about who would actually be involved in the partnership, the LP and the GP. How does the company fit in, and how does, say, a shareholder of that company fit into this equation, or do they fit into this equation?
Well, they certainly do it. And so the company that's signing the lease, they're the ones that need the equipment and will agree to pay the lease. I do think that in general, the lease expenses from this kind of arrangement is probably going to be lower than what third-party leases tend to be, but there's no reason why you can't agree to a different arrangement than somebody else does. So I think there's a benefit to the company in that it's probably going to be lower cost. And so in some sense, you're increasing the profitability of your company, all things being equal, which is pretty good. And then the owner of the company will be the limited partner who has nothing to do with the day-to-day running of the partnership. The general partner is the person, whose duties and obligations are listed in the partnership agreement. Partnership agreement is kind of your DNA for a partnership. Here's what we're doing. Oh, we're leasing equipment. Okay, we buy excavators and we lease them. Okay, let's do this. And obviously the partnership, the general partner has to open a bank account for the partnership, and that's where the limited partner's funds will be deposited until they buy the excavator.
Got it.
And then they buy the excavator, they sign a lease with the company, and now everything starts to flow. And from the point of view of the limited partner who owns the company, there isn't any business risk because they're leasing equipment to themselves. So there's no bit like, if they were a different party, they would look very differently at the risk of leasing an excavator to a company. But because the limited partner actually owns the company, it's a tight loop. But because the general partner is at arm's length to all the parties, the partnership is at arm's length to all the parties.
So it sounds to me like the most important piece here is the GP, and the GP is at arm's length from the company and the shareholder, meaning, that I can't come in and I can't go, oh, I mean, I'm going to create a partnership. I'm a shareholder. I'm going to be the LP and the GP because that's
Yeah.
not a real partnership and it's not
Right.
arm's length. So that's a problem. I also can't grab my wife or my spouse who is, say, a shareholder, or, I mean, she's arm's length to me. So that may not work. Who's the closest individual that would be non-arm's length that could potentially act as the GP?
I presume this could be, you know, it probably won't be your accountant. It probably won't be your lawyer because these people already have relationships with you. It could be a person who was previously your accountant or previously your lawyer some time ago. Like, it's possible you might find them there. You might find them in your business network of people who are trusted and known, but not in business with you.
Right.
And one of the ideas I have thought up is, even though I'm proposing that I of course be the general partner for partnerships. That's one of
Sure.
that's part of where I see myself being involved. But to be fair, if there were company A, company B, the owners of company A and company B, if they are both creating partnerships of similar value, they could barter the general partnership transaction across each other.
Got it. Got it.
And
So,
there's nothing to stop that
scratch
either.
back, you
Yeah,
scratch my back, but
exactly.
again,
And
company
you
A,
both have this. You both have the same risk.
it, exactly.
So
Exactly.
you could definitely. I would be surprised if that's never been done, but I could see where that might be hard to arrange also because you need the same timing, the same amount of money. It may not work for a variety of reasons.
Sure. Sure. And, what I do here as well is that while, I'm a believer, coming from the education sector originally, I'm a believer that you can do anything you put your mind to. The real question is do you have the time? Do you have, the willpower, the ambition, the drive to make sure that all of your T's are crossed and your I's are dotted? In
Right.
my mind, what I see business owners, if they're going, listen, if there's an opportunity here for me to, because I'm picturing a typical business owner, if I'm listening right now, I have one in mind, actually, someone I know very well who has a landscaping company and they do sod and they have equipment and they have all kinds of things. Matt, you know who I'm talking about here. Matt L will hear this in the episode when it goes live. But I'm picturing him right now saying, okay, right now we either purchase equipment in by our company, or we may even be leasing, from some other place. And what you're saying is that there's actually an opportunity here in both of those cases where you could potentially solve that problem and potentially make either, I don't have to come up with all the money in the company this moment, or if I was going to pay, I could now have that payment happen inside this LP, and then the GP is going to manage this for me, and then we're going to lease to our company. I'm going to receive a tax deduction in my company. What's happening on the, like, let's pretend I own the business. I'm picturing Matt right now. He owns his business. He's about to buy a piece of machinery. We'll assume it's an excavator in this particular case. He's about to do it, and then he hears this episode and he says, you know what, I'm going to explore this partnership idea, and maybe even calls Frank and says, Frank, let's do this together. Let's make this profitable for both of us. How do we do this thing? So am I understanding correctly that it's most likely that, say, Matt himself, the business owner, would be bringing the money to the partnership? Or could it
Correct.
actually be somebody else that brings the money to the partnership? Or does that sort of water down the impact or the effect that he?
Well, so in my mind, it's the business owner who becomes limited partner because they then perceive the transaction with no business risk. If it's a third party, they're looking at Matt's company and saying, okay, I like Matt, but now I put $100,000 excavator in his hands and he's paying me a
Right.
lease payment. Yeah, maybe I have to have insurance here. Versus, quite frankly, the owner who's limited partner might say, we don't need to pay insurance in the partnership.
Got it.
Like,
Got it.
how they perceive the risk of all of this is very different because they own the company and they're providing that. But let's not gloss over the fact Matt has to be able to come up with the money himself outside of his company.
Right. He's
He
not
can't use
borrowing.
it.
He's not doing a
So
shareholder
if
loan to
he's if
himself or
he's fully
anything.
tapped out on his own line of credit and doesn't have any money and would choose not to liquidate investments to do this, and the money is only available inside this company, well, then he can't do this. There's a condition of great idea, can't go beyond step 0.
Right. What I'm hearing you say as well, and this makes sense, is that by bringing in, say, another person, say a separate investor into this LP world, we now have we now have 3 parties. So it introduces an additional roadblock, right? It's a bit of a speed bump. Now I have to make sure that, the agreements are tighter. We have to make sure that the company, I want to see all your financials. I want to make sure that, who are your creditors? And, so is it possible? It sounds like the answer is yes. The next question then becomes, is it too hard where maybe it's not worth it in that case? Maybe you'd have to explore, or is it going to be profitable enough to, say, attract someone to want to invest in this opportunity, right? And I know for you, let's pretend there's not an outside investor for a moment. Let's pretend it's Matt, the company owner. Why might there be a case for, say, a guy like Matt to, say, liquidate some assets? I know this particular Matt actually, has a participating whole life policy he might be able to leverage. But let's say he's got assets there. What kind of return might he get, say, in this world versus in the investment world? And I hope I'm not putting you on the spot there when I ask, but
no,
I think, on the
spreadsheet that I shared with you before, I think it's double digits. I think it's probably 15 to 20% before taxes equivalent.
So it could make sense that, even a business owner who is maybe tapped and they're going, like, I've already sent promissory notes to my company, and I've already this, I've already that, but maybe I've got this investment over here personally held, right? So again, we're not talking about corporate assets here. We're talking about bringing this in and going, well, the other option was that I was going to potentially loan this to my company in order to make this purchase, or I could send this money to this partnership, and through this partnership, I could then fund this opportunity and actually be net ahead in both cases, where I'm saving the company money, which is mine, and I'm also earning a return on my end as well.
Yeah, no, that is a great way to summarize the whole scenario here, I think. Yeah,
I love it.
But let's also say this, that if Matt wanted to, Matt's relations, children, spouse, there's no reason unrelated people couldn't, if they all see the transaction the same way because they are related, they can contribute capital to the partnership, and they're also not going to see a ton of risk with investing in an excavator that's being leased to the company that the family owns. Right. So it could be a mixture of Matt and his relations, or even Matt and his employees.
Right. Got it.
Because they're related and they understand it and they see it and they go, I'd like to have a shot. I'd like to be part of this. You couldn't rule that out also. But I would say that anybody who's not related is maybe going to see it differently. And, because they're making a private debt, almost like a private debt investment, modulated through the format of a partnership.
Exactly. So, kind of where I see it is, first of all, and this is what makes private investing, more challenging, right? And why less people do it is that, first of all, in this particular case, you have the business owner who first needs to understand this process is a possible, a reality, right? So there's understanding, there's work to be done. Folks who are listening to this podcast are probably those people, right? They listen and they're trying to better themselves and understand. But then the next roadblock becomes, okay, if it's not me who's the actual investor in this, I now have to bring someone else along, and that becomes a bit of a hurdle. Of course, there's ways that you can mitigate that, and that's what private funds do. That they have to do, but that means there's going to be a big return, which is good, but that also means the risk does increase. It doesn't have to be super risky, though, as long as you have essentially protected yourself with the appropriate agreements. you've done the due diligence, you make sure that, hey, listen, is this company generally successful? What are we going to do when payment, if a payment isn't made? Like, having yourself protected in that way, that's where the legal piece comes in. And you go, okay, I accept this idea in theory. Now let's run this by our legal team. And in a perfect world, you'd work with someone who's done this structure before. Hint, hint, I know someone. And that person would likely already have quite a few of the, essentially the roadblocks removed, right, from the legal process, and the verbiage in the agreements and things like that. So
allow me to interrupt and make a point. This also is that if you went around and said, hey, like Matt, hey, would you lend money to my company? People are going to go, that's a big ask, Matt. That's a big ask. I'm not lending money to your company.
Sure.
Would you buy an excavator and lease it to me?
Right.
So now it's securitized lending, providing of capital in the form of an excavator, which if Matt screws up and doesn't pay enough lease payments, they're going to come seize it back. It's a thing. It's almost like a landlord rental without a tenant. There's no one living in the machine.
Yeah.
But
and it's like, hey, simpler. can you stomach, buying an excavator you never wanted, knowing that worst case scenario, right, you might become a farmer, No, but ultimately at the end is exactly what you're articulating here, is that, if those payments do stop, that you have the legal recourse, right, to actually, take that equipment back, right? So it is secured, which is much better.
The general partner is going to act on behalf of the partnership and do that for you, because the general partner's job is to look out for the partnership.
Exactly. I love that. What do you say we take a little bit of time here? I'm going to open up and share my screen, and you are going to take us through. We'll go through a general scenario, and we're using is it $1 million excavator, I think, that we're going to be looking at here, which would today.
Be obviously more than one excavator, but let's say it's a pool of excavators.
I love the $1 million number, just because it's so scalable, right? So it's like, it doesn't, there's no, say minimum amount. You even articulated in our meeting recently that, hey, if you wanted to, you could do the same thing and do this on washing machines and dryers for a laundromat. Like, the equipment size really doesn't matter. It can be big, it can be small. No. Ultimately, does it help to serve the need? And really what it sounds like to me is that the key to this working is, again, just making sure it's win-win for everyone, right? So, I mean, finding a GP that it's going to be either worth their time, it's got to be worth their time, finding an owner of a company who sees the benefit on both sides, or in that other case where you bring in an investor, what's it going to look like for the investor? So you got to do a little bit more heavy thinking. Why does that investor want to come in and actually do this? How are they going to win? How are you going to win? How's the GP going to win? And ultimately, at the end of the day, though, I mean, as a business owner, as an entrepreneur myself, it's like, this is the kind of thinking that we love to do, right? I mean, that's why we're in this industry.
And it's also the kind of thinking that if you go to and talk to your banker and say, I need capital for my company, they're not going to talk like this, because we're talking kind of open-ended, and who knows where the funding's coming from. If you're talking to the banker, I can tell you where the answer is coming from. It's coming from borrowing from the bank. Right. That's the only answer they're interested in.
Exactly.
And fair. That's what they get paid to do. Fair.
Totally.
So these kind of thinking, I don't know, quite frankly, how many other, professionals will bring this up.
I love it. Well, I think with this example that we have up on the screen,
so
for those who, it should be up there for your screen to see as well there, Frank, but depending.
Yeah, so I see it.
On this screen here, we've got a scenario. So we're going to be investing $1 million in equipment. So again, you're keeping it general. It could be a number of machines. It could be one machine. That's a very, very expensive piece of equipment. It doesn't matter. And I'm going to ask that you kind of go through this with us at a high level. For those who are listening on the podcast right now, hearing it through is, again, you don't have to necessarily follow all the numbers to the T here, but you can find it on YouTube. If you head to our website and head to episode 79, CanadianWealthSecrets.com/episode 79, you'll be able to see the YouTube video and be able to kind of have a look at this spreadsheet with us. But I'm going to turn it over to you. Take us through this scenario so that people who are listening can actually start quantifying the actual benefit of doing this type of thinking engagement?
Right. So it's funny. I'm going to start on the bottom of the list, which is the legal expenses. And I just put a number there because you could spend that much. But as far as obviously legal expenses, you could find someone who might do it for half that amount. But I don't think you want to have a partnership where you don't have it properly structured with a lawyer, with a partnership agreement. So there's going to be some number there, whether it's 20,000 or 10,000 or 5,000 or 40,000. Like it's going to be up to the people involved to figure out what that number should be. But that's a fixed number.
I have a funny feeling that the larger the investment in the equipment, the larger I'm going to want that legal expense to be, because it means I'm going to make sure that I've got the best team. Maybe it's going from a small to a medium, or a medium to a large firm. Definitely. So that's a variable. It's not necessarily set in stone. You've put 20,000 because that seems reasonable, or at least, a reasonable number in comparison to the actual investment of $1 million in equipment.
And on that, legal expenses are pretty straightforward because it's not real estate law. It's corporate contract law. There's just going to be, I need to have a partnership agreement, and I'm going to have a lease. So, and some of these expenses could be happening outside the partnership or inside the partnership, but in any case, they are going to be deducted by the investor who funds the partnership. I think that the 20,000 is probably out of pocket before the partnership exists, but that person can write that off against taxes, which I show down in other parts of the spreadsheet. So all these have impacts later on, but the legal expense you have to start with, it has to be something.
Right.
Then there's just above that is the depreciation rate of the equipment. So there's a range of depreciations probably for this activity. It's going to be between 30 and 50% depreciation. And depreciation just says we can't expense a capital item in the year that you buy it. You can't expense it for $1 million, even though it costs you $1 million. There's rules that the CRA has for how to spread out that cost over a number of years. So that's, in this case, it's 40%. The GP fee is effectively, what are you going to pay the GP to do this activity? Again, I picked $200,000 just for this one, but obviously it could be less. I don't really think it would be more. But in any case, that's a number that also is tax deductible to the investor in the partnership. So notice line 6, the investor has enough tax liability to deduct all the expenses. There really isn't much point in creating a partnership of a size where the person has a surplus of tax deductibility and they're like, I can't make use of this. This is stupid. It's an academic conversation. It's not real. Yeah. So, but it's important to say that. The second line from the top is the residual equipment. Even though you may have depreciated it, down below $250,000, it may be that the market for these excavators in year 5 will be $250,000. So in that case, that's the number that you'd be using. Now we're going to get into what happens at the end of the life, at the end of the lease. At the end of the lease, what we do is we create a corporation out of the partnership, and the limited partners are the people who own the corporation, and the general partner is no longer part of the conversation. The general partner doesn't exist anymore, isn't needed. Their role is finished. We now have a new corporation that came out of the partnership, and the only thing that new company owns, it has a bank account and it owns excavators. That's it. It doesn't have any employees. It's a simple, it's like a shell, if you will, but it's not a partnership. It's a company itself. So now you could have the company that was previously paying the lease is going to pay for this company, pay the $250,000 for the company whose only asset are the excavators.
That's and a bank account with nothing in it.
And they take over a bank account also.
Yeah.
So now you notice what we're doing is we're moving the equipment, not by selling the equipment, because if you sell the equipment, you got to repay the CCA depreciation benefits you've had in the previous years. We're creating a corporation, which we then sell to the OpCo, which was previously paying the lease, and now that equipment is inside the OpCo.
Got it.
And you
Got
get
it.
a capital gains treatment in the hands of the previous limited partners who are now the shareholders of the new company. They get a capital gain of the 250. If it's presumably this is over the undepreciated balance, that's the capital gains treatment there.
Very
So
nice.
is that
Very nice. So this makes a ton of sense. It's making sense as to how this structure works. I now see, I mean, clearly, the GP is going to, earn something for this. And obviously the GP and the LP have to decide what that is to make it worthwhile for them and vice versa. So now how does the LP, where is the LP winning? So the corporation didn't purchase the equipment initially. The original corporation didn't purchase the equipment. The equipment was purchased inside this partnership. The LP, which is also the shareholder of the company, is now likely, as you mentioned, in the most likely sense, is probably funding the purchase of that equipment instead. How do you see the LP benefiting here? Is that lease payment made to a point where the profitability is significant? And like, is there a sweet spot where it's like the lease payments should be following the depreciation amount
That's
of the
exactly what I've done.
equipment?
If you wanted to show more of the spreadsheet here, but you probably don't because people's eyes
No,
will
I
glaze
do. I
over.
do. I will. I
Well,
will roll down.
there's so if you go over off to the right and look down a little lower, you'll see the depreciation schedule, which again is people say, what the hell is this? Yeah. So and effectively we want the lease payments to match the annual CCA allowance. So in the first year, the lease payment's 200,000 because that's the most you can get in terms of depreciation. And so effectively, I don't think the company would ever see a lease payment this low for equipment this expensive. I could be wrong, but I'm pretty sure. In any case, when you're matching the lease payments to the depreciation, you're maximizing the tax benefit and the return of capital, both at the same time to the investor. And you can see it at the end of year 5, the cumulative lease payments is a little over $895,000 that's been made to the partnership. If you go directly up from there, I think you will find this, there we go. So the cost to the opco to pay the 5-year lease isn't $895, right? Because it's deducting all those expenses on its income. Now, again, it has to have enough tax liability for it to deduct these lease payments. I presume it does.
Mm-hmm.
And so using the corporate tax rate of 27%, $895 really only cost you $658. So the company after tax has spent $658, but the investor in the limited partnership has received around $895 less of obviously the general partner fees. And so there are fees, but I'm not saying, but the same token, the general partner expense also generates a tax benefit. So, and I put that over. There's a column of all the 5-year total, if you will, in column B there, and that shows you why the total received by the LP over 5 years is the 895, or a little over 895, and then you have to pay the GP, but you get to deduct that also. Then I include the legal expenses because that's not these are all for the whole 5-year experience. These are not annualized. This is for the 5 years, right?
Right. So
and then you get
at a high level here, and I should state it. We stated at the end of the podcast, but this is not legal, tax, or investment advice. But from a very high level discussion, this is definitely a structure and an approach that is certainly worth exploring for any company that is purchasing equipment where depreciation is a factor, where depreciation is being integrated. My wonder is, and I'm sure there'll be some nuances here that you'd like to tie a bow on, but I'm picturing there's so many people out there that I know in the audience that are real estate investors. Do you see a place where something like this makes sense in real estate? And if the fact that it is typically land sounds to me like probably not, but I'm
no, it
wondering.
is used. So One of my accounting friends is a pretty senior fellow at MNP. And when I bounced this idea, I said, "Am I crazy? Can you do this?" He goes, "Yeah, you can do it all you want." He goes, "But this is too small." He goes, "We only do real estate stuff like this." So if you want to talk about 10, 20 million, $40 million partnerships to own real estate, and boy, yeah, they use exactly the same idea, but the depreciation rate is way lower. It's on 4 or 5%.
Right.
Now the numbers are bigger,
Right.
but the
Which is
depreciation's
where they're
lower,
getting,
and you
they're
can't
like,
get
if
in
we,
there with $1 million.
right. If you make, so if the number's large enough, then having that lower depreciation amount's still going to make a significant difference. But, I'm guessing
Well,
that,
I mean,
if it's a
the way I
low
describe
deal,
this
maybe
is that
not.
for those kinds of things, you won't get tax-free income because you won't be able to match your income with a deduction. You're going to have tax-advantaged income.
Right.
And then I think they also do the flip the partnership into a corp, sell the corp with a depreciated item inside it, because they're trying to get capital
The
gains
recapture.
treatment, really. Yeah,
Yeah.
exactly.
Yeah, exactly.
So I do know that it does happen in real estate, obviously not personal real estate. But then I think your legal costs are going to be a lot higher too. Like
Sure.
a lot of these costs indicated here, if
Sure.
you get into real estate, it's going to be a lot higher, and you're going to pay a broker, right?
Absolutely.
Like equipment is a little more straightforward, but it's also way smaller. It applies to way more companies than the real estate version of this.
For sure, for sure. Well, Frank, this has been an amazing discussion. And I think, you have done, I was going to say we, but really all I've been doing is sort of, following along with you here. And you've done a great job in giving a high level understanding of a Canadian wealth secret that is there and is
Right.
right on a platter and is worth at least exploring, especially for those folks who do have to purchase equipment, who do have to purchase depreciable assets for their companies. And even just this discussion, I'm going to argue that even if it doesn't directly apply to the listeners, I think you've opened up sort of a new neural path for them to kind of, keep their ear to the ground and start looking around. And the beautiful part about this, as complex as the Canadian income tax system is, the reality is with that complexity comes opportunity for creative and compliance strategies. And it really just takes the right thinking, the right people, that open mind, and then of course the necessary research to make sure that you are in fact, following a process that does make sense. So ensuring that, folks, if you're interested in digging deeper into this, I know, Frank, you're going to be sharing your contact information on the show notes page. Is there anywhere else that, and basically before I ask you to share where they can find you, before you do, what would you say is your big, I think this entire episode is a magical secret sauce for people here, but what would you hope that they walk away from after listening to this episode? What's the big takeaway you hope that they take with them?
Well, I think every time they see a cement truck, they should think about tax planning, because it's a great big rolling piece of depreciation. And your question should be, I wonder if that's owned inside a partnership or a company.
I
Because if
love
it's owned in
that.
a company, that's an expensive piece of equipment. Are you really could anybody have funded that outside? And if you're not, you're just missing an opportunity.
Wow, that's such a great one. Now every time I see a cement truck,
That's it.
I'm not going to think about that. I'm going to be thinking about Frank. So, Frank McGillicuddy, thank you so much for joining us here today. Where can folks find more about you? And then, of course, we'll be linking everything up in the show notes.
Well, I'm effectively only on LinkedIn. I don't have a website for my business because I really don't have a business in the sense that you would have as a financial planner. And I work with a variety of other tax professionals. Some of them have websites, but yeah, my name and LinkedIn is all you need. You can get a hold of me.
Beautiful. Frank, it's been an awesome opportunity here. And I know that the Canadian Wealth Secrets community thanks you for taking some time to share this secret sauce with them today. I will link up your LinkedIn profile on the show notes page, friends. This is going to be episode 79. So head on over to CanadianWealthSecrets.com/episode 79 to dig in. And my friends, hopefully we'll stay connected here with Frank. And I'm sure, Frank, you seem like the type of guy that you're going to have a new idea coming up at some point soon, and you're going to want to share it. So we appreciate you for that. And
well,
thanks
it's not
again.
a new idea. I have more ideas.
Yes,
Yeah,
there
exactly.
you go. There you go. Awesome. Awesome.
Yeah.
So you start thinking about the next one you want to share. Who knows, might even become a regular spot for Frank. So we appreciate you, and I hope you have an awesome day. And friends, keep on seeking.
Thank you very much.